You're scrolling through Zillow. Saturday afternoon, coffee getting cold, and there's this specific feeling, like a knot in your stomach every time you look at the numbers. You keep seeing the same thing. $385,000 for a basic 3-bedroom in a decent school district. Nothing fancy, just a house. You're making $72,000. You've saved $28,000 for a down payment, and you're using the mortgage calculator. Principal and interest, it's 6.8%, $2,180 monthly. Property taxes, $420. Insurance, $185. HOA, $95. Total monthly payment, $2,880. And you're thinking, I make $72,000. That's $4,500 take home monthly. Can I actually afford a $2,880 mortgage payment? The calculator says yes. Lenders will approve you. The math says your housing payment is 64% of your take-home income. And that's before utilities, maintenance, anything else. You close the tab, you look around your apartment, and you're realizing the salary you thought was enough to buy a house isn't. Not anymore. Not even close. My name's Peter, and I've been looking at these numbers for a while now. They don't get easier to read. If you've ever looked at house prices and wondered what salary you actually need to afford one in 2026, hit that subscribe button, because the gap between what lenders say you can afford and what you can actually afford is destroying the middle-class path to homeownership. So let's start with what buying a $385,000 house actually costs when you run the real numbers. You're looking at a house listed at $385,000. That's the median home price in a mid-tier city, not San Francisco, not New York, middle America. You've saved $28,000. That's about 7%. You'll pay PMI. Here's your actual monthly housing cost. Mortgage is $2,328. Taxes, $416. Insurance, $185. PMI, $148. HOA fees, $95. Total monthly payment is $3,172. But that's not the real cost. You also need utilities, let's say $220, and a maintenance fund, $320 monthly. Actual total monthly housing cost, $3,712. You're making $72,000. After taxes, $4,500 monthly. Your housing cost is consuming $3,712 of your $4,500 take-home. That's 82.5% of your income. You've got $788 left for everything else. Car payment, insurance, student loans, groceries, gas, life. And this is the craziest part. Lenders will approve this. Banks will give you this mortgage because they calculate based on your gross income, not your take-home. And they use 43% debt to income as the threshold. Your $3,172 monthly payment is 44% of your gross income. You're slightly over, but with good credit, they'll approve you, and you will be financially devastated. Most people think if the bank approves you, you can afford it. That's not how it works. That's the trap. Here's what actually happens when you buy at the maximum the bank approves. Month 1, you move in. The mortgage hits. You've got $1,328 left for all other expenses. You budget carefully. It's tight, but you're a homeowner. Then month 3 happens. Your water heater breaks. Of course it does. $1,400 to replace. You don't have it because closing costs depleted everything. Goes on a credit card. Month 5, property taxes adjust because the previous owner had an exemption you don't get. Escrow goes up $45. Month 7, the AC needs an $850 repair. Another charge. By year 2, your car needs $1,600 in repairs. You can't afford it, so you take out a personal loan. You're house poor. You own a home, but you can't afford to live in it comfortably. And here's why. The bank's 43% threshold translates to 70 to 80% of your actual spendable income going to housing. They know this. They're not stupid. But your financial stress is not their problem. Their problem is loan volume. You're a risk profile, not a person. There's a specific income level where buying a $385,000 house becomes sustainable. Let's run that math. At a $3,712 monthly housing cost, using a realistic 40% of take-home threshold, you need $9,280 monthly. That's $111,000 annually take-home. To net that, you need to earn about $147,000 gross. You need to make $147,000 to comfortably afford a median-priced house today. Not a dream home, the median. And the median household income in 2026 is about $78,000. The American dream of homeownership isn't available at median income anymore. It's available at nearly double median income. That's just the math. Let me show you how this actually plays out across different incomes. At a $72,000 salary, 40% of your take-home gets you a $200,000 property. In most cities, that's a condo or a townhouse. At $125,000 income, you can afford $340,000, which is still below the median house. You need $150,000 to comfortably buy a $400,000 house. The income to housing value ratio is completely disconnected. You're lying in bed, Tuesday night, 1 a.m., staring at the ceiling fan because you can't shut your brain off. You've been approved for a $360,000 mortgage on your $72,000 income. The lender says you're good to go. Your real estate agent is excited. Your family is congratulating you. But you're doing the math. $3,200 monthly payment. You've got $4,500 take home. That leaves $1,300 for everything else. Car payment, $415. Insurance, $185. Student loans, $290. Groceries, $420. Gas, $170. That's $1,480. You're already $180 short before utilities, before maintenance, before anything goes wrong. And that tightness in your chest, it's not excitement about home ownership, it's dread. You're about to sign papers that will financially devastate you, and everyone is telling you it's fine. The bank approved you, you're supposed to be happy, but the math says you can't afford this, and you're realizing the American dream became a trap. So here's how people who actually build sustainable homeownership think about it differently in 2026. The first thing they do, and this is crucial, is they completely ignore the bank's approval. It's irrelevant to them. They calculate their own threshold at 30-35% of take-home and only look at houses in that range. So when they make $72,000 and the bank approves them for $360,000, they shop for a $220,000 condo, not their dream home, their starter home. They prioritize the payment over the property. They care that the total cost leaves enough margin for savings and actual life. And when they can't find anything affordable, they make hard choices. They buy further out, they buy a townhouse, or they just rent longer. They'd rather have a smaller place and financial breathing room than a bigger place and constant stress. What changes is simple. You stop optimizing for square footage and start optimizing for financial breathing room. Not because it's what you envisioned for yourself, because the math requires it. Now, let me be clear about something. This isn't fair. The fact that you need $147,000 to comfortably buy a $385,000 median-priced house is a systemic failure. Housing prices grew faster than incomes for 2 decades, and we're at a breaking point. But understanding the broken system doesn't change your personal math, and stretching to buy a house you can't afford doesn't fix the system. It just devastates your finances. So here's the thing about the salary you actually need to buy a house in 2026. It's not about what the bank approves. It's not about what you think you should be able to afford based on your parents' generation. It's about what your actual take-home income can sustainably support without making you fragile. Most people get approved, buy at the maximum, and spend years being house poor because they believed the bank's approval meant affordability. You can follow the bank's approval and be house poor at $72,000, Or you can follow the math and accept that comfortable homeownership at $72,000 means buying a $220,000 property, not a $360,000 one. The salary you need isn't what you wish it was, and I wish I could tell you otherwise, but the math is the math. And in 2026, that math is brutal, but knowing the math is the only way you survive it.